Hey everybody, welcome back to Drawbridge Finance. My name is Levi Woods, and today I want to talk to you about making money even when your assumption is incorrect. Hey everybody, as always, I'm not a financial advisor. I don't work in the finance industry, and this is an opinion channel about money. Now, a couple weeks ago, on May 5th to be exact, 2 weeks ago on my regular Sunday upload, I did a video about selling put contracts, and I was bullish on Etsy. And so if you guys haven't watched that video, this is pretty much a follow-up to that video. I know there was a couple questions about it because option contract selling can be a little bit confusing to people. But what I proposed in the video, just to do a quick overview, is that I was going to sell some premium. So I was looking at the Etsy stock chart and I was bullish on the position, which meant that I thought that we were going to see a price increase. Now, I know now that I was actually incorrect and the price has actually dropped down from then, but at that time, we were seeing a lot of development. The stock market's been doing extremely well. This is an aggressive company that has an online web store basically and allows people to sell handmade goods. And a lot of retailers have been having a really good, successful year so far in 2019. So I was taking a fairly bullish stance on this, and the stock price was quite high at that time. In fact, in the video I go over, we look at the price of that stock. I'm going to pull it up right now for you guys. So if I head over to Yahoo Finance and I look up Etsy, and we look at the 1 year chart, we go full screen. So originally when I put on this position, this sold put contract, I put it on March 22nd. We had this big down day, and I went over this in the other video, but you could see that this stock was trading way above its 200-day moving average, its 50-day moving average, and its 20-day moving average. It was way up here, and not really a good time to be buying stock. We all know we want to buy stock when it's low and sell it when it's high. That's traditionally how people make money, buying and selling stocks. And in this case, I wanted to start making money without actually owning the stock. So this is why I decided to trade a put contract. Now, the reason that I make these videos is because I think that this is a very important strategy, because the market in general is at an all-time high. If we look at the SPY, and we look at, the last 5 years, this market has just been going up and up and up and up. We saw a little bit of a correction in December. We saw a reduction. And this might be an indicator that we see a market plunge even further. I mean, that's kind of what happens. Markets are cyclical like that. And the last time we saw a major correction was in 2008. And we've been kind of anticipating another major correction for the last 2 years or so, even a little bit further back than that. Anyways, we know it's coming. There is going to be a correction at some point, and being an options trader is going to limit my risk, and it allows me to actually make some money when the market goes down. So this is why I'm covering a lot of option videos on my channel right now, because I think it's important for retail investors to know that there are strategies out there where we can make money when the market turns down. So in this case, I'm not looking for a neutral strategy. This was a bullish strategy on Etsy. I wanted the stock to go up. So I'm going to show you guys exactly what I was looking at. So we had seen a large gap up on Etsy, and we had seen it trading in this high range, like the low $70. And on this particular day, we saw a reduction in the price. There was not a huge amount of volume, but we saw this price drop. And I looked at that and I looked at the premium. Now in this case, the spreads were a couple dollars apart. So I could go for a 55 level way down here, or I could go for 60, or I could go for 65. Those are the kind of levels that I was choosing. Now 65 was really close to where it was trading on this particular day. So it was trading at $66, around there. And what I decided to do was sell to open a May 17th $60 strike put contract for $2.90. For that, I received $282.46. Now, this is in US dollars. Today, I'm going to do everything in US dollars. But basically what happens is you're selling to open one put with an expiration of May 17th, and the strike price is $60. On that day, I collected $2.90. Now, this $2.90 is per share. So it's $2.90 times 100, which works out to $290. And then subtracting the commissions, the actual amount credited to my account worked out to $282.46. My expectation was that this stock was going to rise, or at least stay above $60. And this is what I covered in my May 5th video. So let's see exactly what happened. Now, this contract, if I had held it completely to expiration, which it expired May 17th, just this past Friday, All I needed it to do was stay above $60 and I would keep that credit that I held. Now, of course, it breached under here, but it didn't stay under for very long. This was the earnings report, which we knew was coming out on May 8th, and I was expecting that we were going to see an uptick in the market, not a downtick. So the news was bad, the quarter was not as good as it could have been, and the stock gapped down, but it recovered. So in this case, I held this put contract to expiration. So I sold it to open on March 22nd for $2.90. I received $282. Because it expired above $60, I did not have to close the contract. It expired worthless. The price of the contract will be zero on expiration if the price of the stock underlying, in this case Etsy, is anywhere above $60. So if it was $60.01 or if it was $78, it wouldn't matter. It would still expire worthless, and I would keep the entire $282 that I collected originally. Now that is a stock or an option that I sold when it was out of the money, which means the stock is above the strike price. Then for a short time, it dropped below and was in the money, and then it raised up again and was out of the money. And if it expires out of the money, it expires worthless. But that's not the only way I was wrong. I was actually wrong in another way. So on March 22nd, the stock price was $66.18. I sold one option, $2.90, 56 days to expiration. I sold to open one put May 16th, $60. It required $1,000 in margin, and the net deposited to my account was $282.46. Then on May 1st, I was looking at the chart. The stock was at 68.08, and I sold another option. This time I sold it for $2.95 with only 16 days to expiration, and I sold to open one put May 17th for $65, requiring $2,000 in margin, and I collected $287.46 for this transaction. Right here on May 1st, I opened a second contract. So I've sold the put at $60. Now I've sold a second put, and this one's at $65. So my hope in this case was that I was going to see a price increase, and we were going to see that stock go up in value on the quarterly report. And this is where I was wrong. The stock was trading above on May 8th. The earnings came out, and the next day it opened up lower. So I was still out of the money on my May 17th $60 put, but I was in the money on my May 17th $65 sold put contract. This was a position I did not want to be in. There was not very much time left. I needed this stock to rise back up above this line so that it was going to expire worthless. I was pretty confident that it was going to stay above this $60 line, but I was losing faith that it was going to stay above the $65 range. So I decided to roll out in time. Now this is part of the option trading strategies that we learn, and what that means is I'm going to buy to close my May strategy, my May 17th 65 put, and I'm going to open another contract for the June expiration. So another month out, I'm going to extend the contract and basically extend this line. So at that time, I'm going to buy to close the May 17th at $65. So this, I opened it here, I closed it here. I originally opened it and collected $2.95. Now I'm closing it here for $4.50, and that is technically a loss. Debited $457, and I only collected $287. So I'm down almost $200 on that trade. I am still bullish on this. I haven't changed my perspective of the stock. I still think the value is going to return. So I just wanted to give myself a bit more time. I've extended duration out to June 21st. So what I'm going to do is I'm going to sell a new position at the 65 with this new expiration date of June 21st. And for that, I'm going to collect $5.80. So the credit that I got on that day was negative $457 plus $572. So I actually made money. I had a negative $457 in my ledger and a positive $572. So I'm buying to roll and selling to roll. So I'm closing out the main position. It's completely done, and it's been a loser. And then I'm selling to roll the June position. So now let's take a look. What's going to happen? Well, we know what happened. The price actually dropped down Both of the options were in the money. The price rose back up, and this first option expired worthless because it was out of the money. It was for a put contract. It was above the strike price. And in this case, this one hasn't expired yet because it's now June expiration. So we're below the strike, but we're at a higher value than we were here when we originally sold it. So the price is going up, it's uptrending. I just want to show you guys, if I had decided to close it today, originally I had opened up 2 positions, both expiring May 17th. What if I had decided to close it? What would it have cost me? Well, to buy out this June option today, it would have cost me $397. So doing the math on this position, we would have originally collected $287, then been debited $457, then credited $572, and then today I would have bought out and it would have cost me $397.45, and the total profit would have been only $4.94. Now again, because I'm bullish and I'm maintaining this position and I still have lots of time, I'm going to wait. I am hoping that this stock continues to rally up and gets out of the money, and I'm going to be able to make even more profit than I would. In this case, I wanted to show you the power of options because I was totally wrong. Originally, I opened this position when the stock was up here, and the stock is now trading lower, and I made $282. And then when this contract opened, I was here, and I again thought that the price was going to go up, and it went down, and I actually made money on both trades. Anyways, that's how powerful options can be. And I just wanted to share that with you guys. Let's get rich together.